Anyway, folks, let's get into it. Thanks for joining us on the call today. It is genuinely my absolute pleasure to introduce Rob Price and Sound Money. I'm guessing a lot of people on the call already know Rob. I think he manages funds for a bunch of our customers. From my perspective, Currency Hub has known Rob for many years, and he's always been our and my go-to source for market intel and opinions, really on the greater macro digital asset space, as well as the micro space, especially when you have some crazy coins coming to market or crazy opportunities out there. I've always felt that Rob is not, as some might call a tin hat wearer. He's pragmatic about his views on the markets, and I've always found it to be very, very insightful. As Currency Hub's a resident crypto skeptic, I probably take up a lot more of his time and patience than he would like. What is interesting from his trading perspective is I found he uses, I don't know if they're proprietary, Rob, and you can comment on that, but unique indicators and data points that I'd personally never heard of before, things that I hadn't been exposed to, that really does help Rob's timing and on a personal basis, my timing for knowing when to buy, and more importantly, knowing when to exit. I know for the majority of crypto investors out there, selling is a dirty word, but sometimes we do actually need to sell to try and manage the market's ebbs and flows. He's definitely dragged me kicking and screaming into the space, and for that I think I'm very thankful. I'm at least very thankful for the guidance and insight that he has provided. I think this is a great opportunity for an expert like Rob to demystify and hopefully, Rob, to an extent, de-jargonize the industry, as well as to hear those coherent and pragmatic views you have of where the market is going. I think the market tends to be populated by people who tend to be dogmatic in their positions, and who arguably have been right for the last 10 years. But it's good to hear a balanced opinion and balanced view of the market. So I'm very excited to what you have to hear, and hopefully those people on the call will push you on the questions that I've asked and really kick the tires with the things that you're talking about. So without boring people too much further, I'd like to hand over to Rob and hear what he has to say for us.
Fantastic. Thank you, Warren. It's a very, very generous introduction. I appreciate that. Yeah, great to connect with everybody on the call. And as Warren said, please do shoot through your questions. The chat is open. For all those who've come in more recently, let me know if you can hear me. Write a little yes there in the chat. Maybe write where you're calling in from. Always interesting to know where you're located. And yeah, what an exciting time. I mean, for me, always an exciting time in crypto markets. Um, there's a lot to talk about in 2025, and I just thought it would be a great time to get a state of crypto. Obviously, we're going to keep things short and concise with lots of time for Q&A at the end. I might not attend to the questions, during the presentation, but I'll get to it afterwards. And also, if I don't get to it afterwards, I will follow up personally for sure to attend to your questions. But as I said, exciting time in crypto markets. I think, the key conclusions here is that the market is shifting from hype to maturity, potentially back to some hype again, but the longer term trend is very much towards maturity. So we'll touch on a few of those aspects, with ETFs being a key component, stablecoins being a key component, bringing numerous large institutions into the space. Yeah, these are phenomenal developments, but yet the opportunity set I still think remains sizable. And of course there are risks, and it's important also to touch on those risks, the cyclicality and these new, well, maybe not that new, but the mushrooming of these digital asset treasury companies. So yeah, I hope there'll be something in it for everybody. I expect there will be. But as I said, if we lose you at any point, just write a comment. We plan to have follow-up sessions where we can make things more more investment focused, or maybe more focused on the foundations. Those opportunities are both available to us. So yeah, when I got into Bitcoin in 2016 now, so I mean, coming up to 10 years, the primary motivation for me was concern with central banks. I used to work for a independent financial market research house. Central banks were always a key component of assessing what asset class returns were going to be. And I mean, that's obviously still what I focus a lot of my time on. But the key for me wasn't just those asset class returns, it was this nagging feeling that there was a lot more to it than just that. That there is a consequences to this consistent meddling with interest rates, with monetary policy, and maybe it's being from South Africa and being aware that governments are sometimes inefficient and waste capital, which just reiterated this skepticism with some of these centralized policies. That doesn't mean I'm an anarchist or anything like that. Just for me, I would like to see the separation of money and state at some point in the future. I think that a lot of our problems in the world come down to the monetary system, and obviously, I see Bitcoin as a real tool for freedom. But yeah, I like to think about Bitcoin in these adoption cycles. As I said, I was part of this like 2016 cohort, which were quite freedom and liberty focused. And prior to that, there's not a lot of interest in Bitcoin. It was largely, crypto geeks who were deep in the cryptography weeds. But the cycle thereafter, things really started to heat up. A lot of the concerns which I mentioned, with monetary and fiscal profligacy became very evident in 2020 during the COVID lockdowns. I mean, here in America, I've been in America since 2019, and we actually got physical stimulus checks in the post, and that tells you two things: one, how crazy the times were, but two, also that the banking sector is still utilizing checks. It tells you, the lack of innovation and the challenges in the financial system. But yeah, another key adoption cycle, and more recently, and that brings us on to today's cycle, is the institutional adoption of this asset class. In some ways, there are similarities to previous cycles. In other ways, it is vastly different in 2023, 2024, 2025, and some of the key components to that institutional adoption is of course these ETFs. So anybody who's not aware, ETFs are exchange traded funds. Those are a very cost effective way to get access to various capital markets, commodities, equities, and of course now Bitcoin as well as Ethereum. And these were launched in the United States in January 2024. And it's been an astronomical growth in this investment vehicle. So IBIT is the BlackRock ETF, and you've seen more than 70 billion worth of inflows into that ETF in the last just over 18 months. And what this chart is showing you is comparative flows into other ETFs since their inception date. So to make the dates comparable with each other, and just enormous inflows into IBIT. And I think that's telling you two things: is one, of course, how powerful this technology is and the incredible demand for it. But two, you must be cognizant, of course, that times are different relative to the launch of other ETFs. And I do think that financial markets are in increasingly stranger times. With increasing usage of monetary and fiscal policy, which makes scarce assets like Bitcoin increasingly more attractive. Another key component is this is the decision by the US government to make Bitcoin a strategic reserve asset. They aren't actually conducting net new purchases of Bitcoin at this stage, but just the reality that they are calling Bitcoin a reserve asset is a phenomenal development. I mean, in years gone by, people used to laugh at me when I tried to, particularly in large financial institutions, try to speak to them about Bitcoin. But yet now the US government is calling it a reserve asset on an equivalent level to gold, to develop market bonds. And you are seeing other governments have similar conversations. So you can see how momentum picks up here. It doesn't mean that, a number of governments are necessarily going to announce that in the very short term, but the fact that the conversation is happening means that the whole narrative has shifted much more towards credibility. Very rarely do we get questions these days about the idea that governments are just going to ban Bitcoin. And that is it's a sea change and a key component to this institutional adoption. I'm gonna try and avoid just shoving lots of graphs down your throat. That can be my tendency. But yeah, it's not, it's the reserve asset, it's the ETFs, it's derivatives too, a sizable growth in derivative market in recent years. Another sign of an asset class that is maturing. Um, and I think it's really critical to make the point that while the market is maturing and things are obviously changing from an optical perspective, the number of institutions that are involved in this asset, the actual underlying technology, certainly on the Bitcoin front, is not changing much. And that's a good thing. Bitcoin remains and always has been decentralized, scarce, digital money with the ability to send to anyone, anywhere in the world, at any time of day and any day of the week, and similarly to be able to receive. That always has been and continues to be a profound innovation. You could not do that before Bitcoin, and now you can do that. And it's not only can you do that, but you can do that in large size because it's a deeply liquid network. If you want to send $10 around the world, you can do that. If you want to send $10 million around the world, you can do that for reasonably similar cost, reasonably similar settlement times. And of course, you can send this peer to peer. So I think it's really important to come back to that foundation that the technology is unchanged. Bitcoin remains this North Star, and it is, of course, in stark contrast to the centralized fiat system. Fiat is just traditional government issued, government decreed money, rands, dollars, euros, centralized, rapid supply increases, the risk of big depreciation in that unit, and of course, red tape, jurisdictional restraints. And we are reliant on intermediaries, and of course, many of those do work in our interest, but many of them don't. Um, so yeah, it's despite all the change, all the layers, these are basically in all of this institutionalization, all these products that are being built on top of Bitcoin are basically layers on top of Bitcoin, and they're integrating Bitcoin into traditional financial markets. But actually, Bitcoin itself is this North Star, this constant, which is incredibly powerful. And well, despite also the astronomical growth that we've seen, Bitcoin increasing to a $2.5 trillion market cap, it still remains tiny relative to traditional asset classes. So gold is, of course, the easiest comparison asset. Gold also being a non-yielding, non-interest bearing asset, which you can trade peer to peer. Of course, a lot of people hold it in ETF format. That's trickier to trade it peer to peer. But a comparable asset, a true kind of monetary asset. But yet, gold is, approximately 10x the size of Bitcoin. I think it's very viable to continue to think that, Bitcoin can grow up to the size of gold. It has been gaining ground, of course, but in these current conditions, gold has also been it's been gaining itself. So what I'm saying is that there's a lot more potential in this asset class, despite the fact that we have seen large gains over the last, 10, 15 years. And of course, the comparison doesn't end just at looking at gold. In reality, most global assets do have some similarity in the fact that people are often trying to store their value. They're trying to store their value over various time horizons, but they're trying to store their value over time. And of course, these different asset classes have different underlying, like, vectors, drivers, and risks. Equities being largely, exposed to growth, um, whereas government bonds being exposed to the credit worthiness of sovereign nations. Um, but yeah, you can, of course, make the argument that, that from a store of value perspective, that Bitcoin also can be compared to these other asset classes, and particularly actually relative to bonds, which historically have been kind of this defensive component in traditional portfolios. But question marks are increasingly being raised in that regard, and it's funny when, when I first came to America. People would I know if you say you're from South Africa, they sometimes often wouldn't say particularly much about it. Sometimes you'd get a little fortunate mention of Nelson Mandela, and this gentleman obviously came well, he's been on the scene for a long time, but increasingly in the focus of Americans, and people often would want to talk about Elon Musk. And I guess the last 12 to 18 months has been a slightly more challenging conversation, particularly here in California, because a lot of people don't like his politics. But yeah, interesting how times change, and how and also how that grabs people's attention. Elon Musk I was head of Department of Government Efficiency here in the United States, and had this big push to reduce spending, narrow the deficit, reduce debt, and it's just turned out to be a massive failure. And I don't think just I don't want to talk about Elon Musk's politics and don't have too much of an opinion on him. But listen, he's obviously a very driven person who does a lot of execution, and for him to have such a big failure on such a big project, I think is noteworthy. Not about him, but just about the challenge here, because the reality is it's just an incredibly difficult thing to do, to lower the deficit, and they've failed. They've turned their back on it. Here I'm looking at the U.S. deficit as a percentage of GDP. This thing is wide, is perpetually wide. I think what's particularly interesting is how wide it is, given that economic growth is actually pretty strong. Unemployment is pretty low in the United States, but yet there's very little appetite to lower the deficit. Debt levels continue to rise, and the value of these bonds is in question, and you're seeing a lot of shifts in the financial realm with the largest non-US holders of government debt, China and Japan, selling down on their holdings in the last year. So basically, I'm making the point that the opportunity set here remains large, it remains profound. And I think that Bitcoin has gold in its sights, and I still am bullish on gold. I think it's a powerful asset, and gold and Bitcoin don't always tend to perform at the same time. But yeah, the opportunity set for Bitcoin to grow into potentially the global bond market and compete sections of it away, I think is also a particularly is strong, and something to be cognizant of. And despite as I said, the opportunity set that I think is still massive, where we've got to now, this large, $2.5 trillion asset, or, $3.5 trillion if you're looking at the rest of crypto. Um, this is, yes, small and lots of potential to grow, but is large, is institutional. And so I think the key change here in the narrative is also what is the benchmark allocation to this asset class? And historically, people used to think it was just kind of throwaway money to put some small allocation in. I think that was understandable in the past, but the benchmark has now changed. And I think the benchmark is more in the 1 to 2% level. And allocations that are below that are underweight the benchmark. And that, of course, presents challenges in a balanced portfolio to actually be underweight what is increasingly a key asset in the monetary and financial realm. And we've always said that low allocations to Bitcoin have very low impact on portfolio volatility. This is, just a brief kind of portfolio scenario test. So you're looking at a 60-40 portfolio, 60% S&P 500, 40% bonds, and the drawdowns from that portfolio over recent years, with the biggest drawdown being during the COVID crash at 20%. And that's just to confirm, that's just bonds and equities. And then just running a scenario of what it looks like if you start adding in smaller allocations to Bitcoin and obviously rebalancing the portfolio. So 1%, the blue line, what's the drawdown do? Negligible impact. Adding in 5%, well, you start to see this purple line is pulling a little bit lower, some slightly bigger drawdowns. And of course, up to the 10% mark, you start to see bigger increases in drawdown. So, at the trough here from 20% to 25%. Of course, at other times there've been, bigger discrepancy, 7.5% here versus 15%. So more of a doubling in drawdown at a 10% allocation to Bitcoin. But of course, what you're getting in return historically is, from the zero allocation up to the 10% Bitcoin allocation, that's almost, a 10x increase in returns. So, yeah, I think the benchmark has changed. Obviously, the actual allocation depends on the individual, their risk tolerance, their age, their understanding of the asset. We have elderly investors that have significant allocation to Bitcoin, not because it's advocated by me, because they have great confidence in the asset class. So one of the really big, I mean, it's been a development for a while, but has really caught the headlines in recent quarters has been stablecoins. Another key aspect to this institutionalization and maturation of the asset class. So let me, touch on briefly also what are stablecoins? Well, stablecoins are dollars on a digital rail. So, if you think about it, traditional money, not just dollars, rands, euros, they aren't truly global. I mean, that seems more obvious, of course, in the rand context, but even the dollar is the globe's world, the global reserve currency, right? So it is accepted around the world. But it's not very easy actually to send dollars from one place to another. You have to go through lots of intermediaries, you have to get all sorts of approvals, and it's particularly challenging if you want to open up a dollar account in non-US countries. That's a challenge for emerging markets. And you often see people in emerging markets, hoarding dollar cash, which comes with numerous different challenges. So, stable coins actually came across as just a problem-solving device in emerging markets, and where crypto traders, were obviously settling, Bitcoin, which as we've talked about, settles 24 hours a day, 7 days a week, uh, and but dollars on the other side weren't. And so stablecoins kind of closed the gap there. So basically, what you've got is a global version of the dollar, which is faster, which is cheaper, which settles 24/7. And you can also use it peer to peer, which is powerful at a time when cash is being pushed out of circulation by governments. So this is a version of digital cash. Not perfect relative to Bitcoin, and it's still centralized. That has certain challenges, but a powerful innovation. And as I've mentioned, particularly powerful in emerging markets because while, as a Bitcoin advocate, I'm not particularly constructive on the dollar long term, but of course, relative to emerging market currencies, I mean, the dollar is great. Here's a chart of the Turkish lira, dollar versus Turkish lira, TRY, and you see the immense devaluation of this currency in recent years. So, people in Turkey have got a high adoption of stablecoins, similar in Nigeria, in many African countries, and in South Africa too. There's lots of merchants now in South Africa that allow people to pay in Bitcoin, but also in stable coins. So this is a it's a remarked innovation, and we are also seeing this is in a chart of the volumes for stablecoins relative to Visa, and you see how stablecoins have now overtaken Visa volumes. So this is yeah, it's a remarked development, and you can understand why these payment providers, Visa, Mastercard, Stripe, PayPal, well, they've all adopted stablecoins in the last few years, and we're going to see a lot more of that because stablecoins are eating their lunch. They're faster, they're cheaper, they're 24/7. So yeah, it's and the big development in the last year in particular. I mean, this trend was already well underway, but we're now seeing the US government, through the Genius Act, green light stablecoins in the United States. Um, and they are effectively regulating stablecoins as money market funds. And maybe also taking a step back again on the technology here, because there's lots of different types of stablecoins. Some of them are quite risky, so not all stablecoins are created equal. But the default type of stablecoin is a fully reserve backed stablecoin, something like USDC or Tether. And in that instance, what is the issuer doing? They're issuing this digital token and then they're holding reserves on the back end. And with USDC, it's fully UST bills, so short-term, short-dated government debt. So they're holding all of that debt in reserve. Um, So often you get questions about, are these things safe? Well, those are safer than bank deposits because in the bank, you only have a fraction of the reserves held on deposit. The stablecoins, they're fully reserve backed, similar to money market funds, but you're able to send them peer to peer. You're able to send them, globally. So that's very interesting. And this component of stablecoins holding such significant treasuries is a major geopolitical event because we've touched on how the US government has got a lot of debt, has got wide deficits, they're issuing a lot, they need demand for their debt. But at the same time, you can see that, this on the chart, last year, Japan and China were selling down on their debt, right? That is a problem for the US government. But Tether is the largest stablecoin issuer. They was the seventh largest purchaser of treasuries in 2024. So, I mean, I've long said for many years that, because often you were getting people talking about CBDCs, and we can get onto those in more detail in the Q&A if you like, central bank digital currencies, and when's the US going to launch a CBDC? But my view has always been that the US government in particular, would adopt stablecoins because they hold US government debt. They also advance the hegemony, the dominance, the dollar dominance around the world. And those are very powerful tools for the US government. Anyway, that's indeed what we saw. And I think one of the key implications also here is that one of the risks long term we always have to be aware of in crypto, particularly at the moment, because the current administration is very favorable towards crypto in the United States. And of course, that can change, and we need to be aware that risk exists. Um, but the fact that stablecoin issuers are such significant holders of US government debt does create a strong incentive for any future political regime in the United States to be somewhat positive towards these stablecoin issuers, and as a result to the crypto industry, because we can't forget that yes, stablecoins are dollars, but stablecoins are very much part of the crypto industry, and I do see them as still bridging to Bitcoin. Um, the regulation has added credibility to the crypto space. That's incredibly powerful. And of course, once people have stablecoin accounts, stablecoin wallets, they are opened up to crypto wallets, and that makes them much more receptive to holding Bitcoin. And as of course we've already said, the dollar is expected to depreciate relative to scarce assets, relative to equity, relative to property, relative to gold, relative to Bitcoin. And so once, yes, the dollar might be, holding value relative to the Turkish lira or relative to the South African rand, but it's not holding itself particularly well. It's not holding value particularly well relative to Bitcoin. So yeah, I think this is going to spur on a big adoption wave over the coming years. I think the last point to make here on stablecoins is an interesting one, particularly from an emerging market perspective, is just what pressure are is the adoption of these stablecoins in emerging markets going to place on emerging market currencies themselves, right? If there is big demand for stablecoins in South Africa, for instance, does that reduce demand for the rand? Now, I think South Africa is in a less extreme position. It doesn't have as high inflation. It doesn't have as high currency depreciation as places like Nigeria and Turkey. But it's an interesting thought experiment, and I do wonder whether over the coming years that we're going to see, some frustrated emerging market currency governments. We've actually already seen little bits of that in Nigeria over recent years. Less about stablecoins; they were more concerned about Bitcoin. But yeah, it's going to be an interesting development to follow. All right, so next is the Bitcoin cycle. So, a question that I often get is, where are we in the cycle? Is it going to continue in its traditional format? Um, what are the risks? So for those who are, not aware, Bitcoin does historically go in a 4-year cycle. Um, it does historically go in a 4-year cycle with a bear market um, every 4 years. So here's a quick chart of that. Now this is just looking at annual returns from Bitcoin with the bear markets in blue. And if you were to follow that pattern, I mean, you could expect a bear market next year. So it's understandable that people have this question in mind. So let's hit this one on the head. Yeah, for me the cycle is. And it's not also it's not maybe as clear answers, you would like. I do think that the cycle has changed in many different respects. The first aspect to mention here is that the halving. Anybody not know about the halving? Drop a message in the comments if you're not cognizant of what the halving is. But very briefly, that is when Bitcoin supply growth gets cut in half. That historically has been a very key event in Bitcoin's life cycle. But as the market cap grows, that halving event is increasingly less important over time. And so that is not as relevant as it was in the past. Of course, on top of that, we've seen this institutionalization of the market. We've seen these larger players, more sophisticated players, enter the market, and that is clearly, if you can look at it in some metrics, has changed the market structure of Bitcoin. This is looking at an implied volatility on Bitcoin has been grinding lower. Um, it doesn't mean that it's going to grind lower indefinitely. I think we can very well make the argument that volatility will tick up again in the coming quarters. But the long-term trend here is towards lower volatility. You see similar things in drawdowns. Bitcoin drawdowns have become increasingly muted this cycle relative to previous cycles. And just to confirm, a drawdown is the percent drop from the most recent high to current price. So yeah, the market structure is clearly changing. You can see that in the evidence. So that, for me, I think that the conclusion is that it would be imprudent to just expect this 4-year cycle to just continue because, and in fact, I almost think that at the moment, if you talk to a lot of crypto participants, which I do, I run a crypto meetup here in Los Angeles, and it's almost a lot of people are like almost preempting that we're going to see this bear market, and I think that's actually contributing towards kind of some of the early softness we've seen in price. But just because just because people are expecting this bear market doesn't mean it's going to come to fruition. I think that a lot of people could actually get caught off sides. Um, and that price can push higher because I don't think institutional participants are maybe thinking about allocation in that sense. Um, but yeah, like a typical economist, I will also talk about on the other hand, I think it's also very imprudent to rule out the cyclicality of this asset altogether. Bitcoin is a non-yielding, a non-interest bearing asset. Types of assets like that, and like gold, are prone to speculation. They're also very difficult to value, and that tends towards diverse and divergent valuation outcomes. Is some people think Bitcoin is still worth zero. Some very smart people think that, and other people think that you should be worth, multiple millions of dollars. And so the market oscillates, particularly in times like this where there's so much liquidity sloshing around markets. Markets will oscillate from one extreme to the next, and overpricing and underpricing. Um, so, that, concludes for me that yes, the cycle will look different in the past, to how it has in the past. But to rule out cyclicality altogether, I think is imprudent. And these new participants, ETFs and digital asset treasury companies, which you're going to get onto in a moment, yes, they're more sophisticated in their execution, which is changing the market structure, but it doesn't mean that they're not prone to sentiment. Because at the end of the day, ETFs are held by individuals largely, not all, but a lot of them are individuals holding Bitcoin in their brokerage account. Now, there might be different types of participants relative to your just, retail people who are buying some, Bitcoin on exchange. But I still think they're prone to sentiment. And once again, in my experience of running a Bitcoin meetup, we've seen a lot of kind of older participants come through to the meetup, yeah, buying Bitcoin via the ETF. And listen, these are the smart people, and they're very wealthy, so they're allocating lots to the market. But I don't think they're particularly sophisticated in their knowledge about Bitcoin, or particularly sophisticated in their knowledge about markets. And I think that they're going to be prone to the same shifts in sentiment that many other participants are. Um, So, touching on, I mean, I don't know if many of you have come across these digital asset treasury companies. Um, these have been a really key component of the market over the last year or two. It all started with MicroStrategy. MicroStrategy has been around for a long time, but they started buying Bitcoin in 2020. They became kind of a pseudo ETF before ETFs were launched. Um, and now they're kind of like a leveraged Bitcoin vehicle. I do think that there is underlying kind of reason for some of these entities to exist. So I'm not, standing here being outright negative on all of these. Warren holds a far more skeptical view of it than me, but I do think that even though we have ETFs today, and maybe also just to pull back the lens even more, like what is that entity? It's a listed entity that is buying Bitcoin. Right, and it's a different way to get access. Now, of course, the advent of the ETFs does reduce the value proposition somewhat, because, of course, it might be easier and simpler to get access via the ETFs. That's understandable. But there's still lots of investors that can't necessarily buy, spot Bitcoin, cold storage Bitcoin. They can't necessarily buy the ETF. Some people are restricted in that sense. And there's certain types of investors that can only access certain types of instruments. So what MicroStrategy's innovation is that they are kind of marketing all sorts of financial market products in different capital structures to funnel capital into Bitcoin. So they've obviously got the equity, but they've also got convertible bonds. They've got preferred stock. They've got different types of preferred stock with different interest rates, different coupons, and these are there are opportunities for people in those markets who don't otherwise aren't able to get access to Bitcoin to get access to that. So that is an innovation. There are also examples. There's a company in Japan called MetaPlanet. I think their kind of innovation is that it's challenging for people in Japan to get access to spot Bitcoin. I think there's negative tax treatment. I think that's the key there. But once again, there's a market opportunity that company is accessing on. And yeah, I said there is a reason for them to exist. And they are also very reflexive on the upside. So because kind of how it works is that as the market values that company higher as an enterprise value, and if it's higher relative to what they hold in Bitcoin, then they've got an incentive to buy more Bitcoin, to issue more equity, to buy more Bitcoin. And that can create a flywheel of positive momentum, buying more of the underlying, actually pushing the underlying up, getting more interest in their vehicle and just, perpetually kind of moving in that direction. And, you can see how that can be a force for positive. Obviously, it can also work on the end, which I'm going to get to in a second. But just, before kind of moving away from MicroStrategy, this is a chart that shows the market cap of MicroStrategy. So when they started this change in strategy of holding Bitcoin, they had about a $1.5 billion market cap. They've now got a $90 billion market cap. I mean, that's an astronomical return, an increase in value of the entity. And yeah, I think in years to come, people will look back at this as an absolutely remarkable event, and there'll be lots of case studies and so, go into all sorts of textbooks. And of course, that's encouraged a lot of copycats, and that's really where the risk lies. So. I'm not sure that we need lots of these treasury vehicles. Some there can be reason for them to exist, but lots that is more of a concern. And just like I said, they're reflexive on the upside. They can be reflexive on the downside because what if that we talked about a premium of enterprise value relative to net asset value, so a premium of how people value the company relative to the underlying Bitcoin encourages more Bitcoin purchases. But what if that goes the other way? What if equity markets turn sour for a period of time? What if Bitcoin turns sour for a period of time? One thing I've learned in Bitcoin is don't underestimate ever the potential for downside price volatility. And if that's the case, then the incentive would be to sell. If the enterprise value is below the net asset value, the incentive is to sell your Bitcoin to boost the enterprise value. And so this, looking forward, I think these are big vector for risk. So listen, we're obviously incredibly excited about the market. I think it's still in a very healthy position, but this is a risk that is emerging, is developing in crypto at the moment. And here I'm just very briefly showing you some of these premiums. So this is on Ethereum. These premiums relative to NAV. In reality, they should be a one. Um, that would be the enterprise is valued directly as, one for one with the underlying coins that they've held. But you've seen, times these premiums blow out, and this tells you that people are buying the underlying for a very expensive price, and that tells you that, that this, I mean, that's a bad decision. You might be underwater for a long period of time. So yeah, looking further out, at some point when markets turn sour again, I expect these digital asset treasury companies to be a vector of risk, to be forced sellers, to potentially perpetuate another bear market again in the future. That's not what I'm foreseeing in the short term, but we need to be cognizant of these risks. So closing up, last slide from my side is just another indicator. We've got obviously a host of different indicators. You want to see more of them, you let me know. This is our macro indicator, and it really ties nicely together a lot of the things we've spoken about today. The underlying components are things like real interest rates, money supply growth, the deficit. All right. When it's high, that means that the deficit is wider, real interest rates are lower, more money is being pushed into the economy. In essence, that the dollar and the dollar system is being devalued. That is a good time for scarce assets. It's a good time for Bitcoin. So that's the macro indicator on the right. And what you're seeing here next is the is Bitcoin in log returns on the right-hand side. And you see the strong relationship between Bitcoin and the macro indicator, a key component of our investment process. And so for us, macro conditions are incredibly supportive at the moment. And it's difficult to be negative on the market at this stage. Yes, there are risks emerging. Yes, the market is frothier today than it was a year ago, than it was 2 years ago, than it was 3 years ago. But we still remain very constructive for as long as this macro indicator, and we have I said, a host of different indicators, but this is a critical one. It still remains very constructive. And in terms of like kind of actual news flow, we're expecting, Federal Reserve interest rate cuts over the coming quarters, and potentially even a removal of the Federal Reserve chairperson, Jerome Powell, towards potentially a yes man, because Donald Trump wants to cut interest rates significantly. And I don't think that's a good thing for the world. Um, but it's our expectation that interest rates will be low, real interest rates will be low, and that will be good for scarce assets. That's why we protect ourselves through investing in these critical assets. So I'm going to pause there. As I said, this market is shifting from hype to maturity, potentially back to some degree of hype again, but the long-term trend is towards maturity, increasing infiltration into traditional financial markets through stablecoins, through ETFs, and it's also useful to note these stablecoins are one step in the tokenization trend. We've tokenized dollar cash. In the future, we're going to be tokenizing dollar bonds. We're going to be tokenizing equities. We're going to be tokenizing all sorts of things, bringing more and more capital into the crypto markets, more and more familiarity into crypto. Um, and yeah, for me, the new benchmark as this asset class becomes institutional is a 1 to 2% allocation. But of course, as I said, we are cognizant of the cyclicality, of the volatility, of the potential for bear markets. But yeah, we're looking forward to kind of navigating that volatility again when it does arise. I'm going to pause there and answer any questions. I'm also going to put up a poll. It'd be great to get your thoughts, and we might run, many of these again in the future. So, let us know what you'd like to see more of. So I'm just putting up this poll here. There we go. So I see a question from I see a question from Pierre about the opinion of gold-backed stablecoins, or in or emerging markets, given the forecasted dollar depreciation. Listen, as I said, I'm still constructive on gold. I mean, a gold-backed stablecoin would just be, um, that would be tokenized gold. So, and that does exist already. You can get tokenized gold. Paxos has Pax Gold, I think it's called. I think it's a useful instrument. I said I'm constructive on gold. Gold is the preeminent store of value, been around for hundreds, thousands of years. I think it has continues to have a place in a portfolio. I do think that Bitcoin over the long term is a superior asset, but of course there are advantages and disadvantages of both. I mean, with gold, it's very difficult to actually trade it peer to peer. It's very difficult to transport. It's expensive. It's not very portable. But I mean, there are other challenges that you don't have with gold. With gold, gold is gold. It's gold is gold. It's a physical item. With Bitcoin, still is a technology. It's not something that keeps me up at night, but there are software upgrades that need to take place. There are risks that on our horizon, things like quantum computing, are considerations that are of zero consideration for gold. Um, yeah, but I expect, gold is doing well. I expect it to continue doing well. Yeah, so in terms of the macro indicators, listen, and a key indicator is the one that we put up there, right? Our primary macro indicator is, a cornerstone to our investment process. I can bring up just, one or two others here, just, for your interest. Let's see here, unhide this. So here's another example. This. This is looking at so on-chain data is something we spend a lot of time on. That's looking at the underlying Bitcoin blockchain. And I mean, ignore the orange line is just the Bitcoin price and log access that in log format on the right-hand side. Um, the blue line is looking at long-term holder supply. So that is the percentage of Bitcoin supply that is held by long-term holders. Long-term holders are classified as those that have held for a longer period of time, as opposed to short-term holders that have held for a shorter period of time. And the theory being that long-term holders are more illiquid, less likely to sell their assets. What you see here is that the percentage of Bitcoin supply that is held by long-term holders is incredibly high. I mean, it's dipped a little bit in recent months, but it's still not far away from its all-time high. Historically, for bear markets, like for instance, to emerge, you need to see these more protracted periods of selling down from long-term holders. And so that's something, for instance, that we'd keep an eye on. But yeah, we have a host of different indicators. We look at leverage levels, we look at liquidations. But I said the key is kind of these long-term ones. These will, really tell you where you are from a cyclical perspective, and those, like when these turn, that's when we're more likely to be shifting allocation substantially rather than just trimming around the edges. So Nicole asks, is it not too late to invest into Bitcoin? Well, the reality is that is always, I guess, a question that people ask themselves. Like, I asked myself that question in 2016, was it not too late? And listen, as I said, you can still get protracted periods of decline in price. So one needs to be cognizant of that. But long-term returns from Bitcoin um, like 5-year returns. I'm trying to see if I can bring up that chart for you. Are very strong. So the 5-year returns, even 4-year returns have never been bit negative in Bitcoin. So even if you were to buy the top, if you have a long-term time horizon, then you do well at the end of the day. The most important thing is to say, listen, do I understand this asset? Do I want to be allocated? And actually thinking about that from a percentage of portfolio. Yes, the timing can still be a important question, but I do think it's of secondary importance relative to actually saying, am I allocated and is it commensurate with my risk tolerance, with my knowledge and my age? Um, and in terms of like specifically where we are in the cycle, sure, I do think we are in a stage of the cycle that we could see other assets outperform relative to Bitcoin. But I'm not saying, don't invest into those. What I'm saying is that Bitcoin is the North Star. So for instance, if you're getting into crypto for the first time, then I'd strongly encourage you to focus on Bitcoin. And if you know what you're doing, and you're looking for something else, something a bit more interested and differentiated, sure, look at other things. But the starting point is always Bitcoin.